All right. Good afternoon, everyone. So today we're going to talk about collateral management and securities lending and borrowing. Okay. So we'll talk about collateral management first, and then we'll go into securities lending and borrowing. Okay. Now, now, can anybody tell me what is collateral? What does the term collateral mean?
The things which is easily converted into cash.
Okay. One is in terms of its liquidity, that it can be easily converted to cash. Okay. What else? Okay, it's a pledged as a security. Okay. Now, when we largely look at collateral, right? The concept of collateral has been part of finance forever. Okay, it's been part of finance forever, and and the idea was that, see, only in the last, let's say, 30, 40 years, we have, derivatives and, more complexity in the financial markets. But if you look at 300, 400, 500 years ago, the main asset was land. Okay. And if you wanted to do anything, right? If you wanted to, uh, or let's say you're a farmer or something like that, and you wanted to do something, or you want to grow more crops or whatever it is, right? You generally would have to give your land as collateral. Okay. Now, as we move forward in time, right, the collateral still largely has not changed. Okay, because the idea that collateral, why we ask for it is, we are worried that, hey, what if you and I do a transaction or a deal, what if I default? Yeah, that's what, or you might default. Okay, that is also there. So that's why when we talk about collateral management, right? um, it is an important aspect within the trade flow. Okay, and also its importance, especially after the 2008 financial crisis, has grown, has exploded. Okay, like the collateral management space has become a huge market by itself. Okay, so when we talk about collateral management, what the classical definition is that means providing security in the form of property, cash, gold, and securities against a possible payment default. Okay. Now, some of the features of collateral are: it acts as a guarantee, it is a credit enhancement tool, and it allows you to help manage a crisis. Okay. Now, when we look at what do you call it? Collateral, right? Property, like I mentioned, was the classical asset that was used. Okay, gold, or so gold is largely uh, more easily available and has more value as compared to silver, right? Now you have other precious metals like platinum, which are obviously worth a lot more than gold, but you don't have that much supply in the market. Okay, so that's why gold has been a very good collateral, and securities as well, right? So that is, let's say, more recent, let's say in the last 20, 30 years. Securities are also acts as a collateral. Okay, now here the securities are again, well, I'm going to be telling you guys it's largely going to be fixed income securities, and specifically bonds, and in that bonds it will be government bonds that act as a security. Others, not really too much, will act as a collateral. And equity as well. I haven't heard of instances where you accept equity as a collateral. It does happen on the retail side, but on the investment banking side, generally it is going to be government bonds that act as a collateral. Okay, and all of this is used against the possibility of a payment default. Okay. All right. So is this clear of what is collateral? And so can anybody tell me, what do we mean by it acts as a guarantee, it's a credit enhancement tool, and it helps you manage a crisis? What do those three terms mean? what does the term guarantee, credit enhancement, and managed crisis mean?
Guarantors do not get default on any transaction that happen between
Okay.
both the parties.
Okay. Anything else? Okay. So guarantee is that in case there is a default, right? The lender can sell collateral and recover the amount lent. Okay. Yes, it acts as assurance as well. And yes, of course, improving credit risk profile for business. Yeah, very good. Okay. Yeah, so basically, these are the key features when we look at collateral, right? It acts as a guarantee, it's a credit enhancement tool, and it helps you manage a crisis. Okay, take a minute, write this down, and then we'll move on. Let me know when you're done writing. Okay, all right. Now, let me ask you guys this, okay? Now, if let's say that, let me actually break this up, okay? Now, let's say that if okay, hang on, let me put it another way. So, in terms of a default risk, now let's say that I'm the client and you're the broker. In which market do we have a higher risk of default? So, if I'm the client and you're the broker, okay, in which market would I have a higher chance of defaulting against you? Would it be the exchange market or the OTC market?
OTC market, sir.
Okay, are you sure? Okay.
Yes.
Okay. All right. All right. So just hold on to that part, okay? I will come back to it, okay? Now, when we talk about the types of, yeah, you are to, I mean, okay, I'll come back to that. Okay, so when you talk about collateral, right? Now, collateral is, so for example, if you and I do a deal, right? So if we do, and all of you are saying that there's more risk in the OTC market, okay? I don't deny that, okay? There is, that risk is there, okay? But now when I ask you guys, or if you guys can think about it, how would I give you collateral? Which way would I transfer the collateral to you? In what market would I use to transfer the collateral?
Sir, am I audible to you?
Yeah, yeah, go ahead.
Sir, when you borrow money from me
Mm-hmm.
in cash, like 1 lakh, you are borrowing from my side. Then
Mm-hmm.
you will be giving me some collateral as gold
Mm-hmm.
on the behalf of your borrowing money in OTC market.
Okay, yeah, that's correct. No, but my question
Yeah.
actually is, how would you give how would you give me the collateral? Can you use the exchange market to transfer the collateral, or would you use the OTC market to transfer the collateral? So what I'm saying, Vibhor, is that so let's say that you and I get into a deal, okay? So the collateral, how will you transfer it to me? In what market? Will you transfer it to the stock exchange, or will you transfer it to the OTC market? What about the others? Everybody went to sleep? Yeah. So when you talk about collateral management, right? Collateral management is done in the OTC market. Yeah. Yeah. So it will be done in the OTC market. You can't use the exchange, okay? Because exchange, that is a different mechanism altogether. Now, if we are doing if since we are trading, or I mean, we're managing the collateral in the OTC market, therefore, what guidelines would you have to follow? What do you guys think? What guidelines would you follow for the collateral management piece? Yeah, correct. And yeah, it's ISTA. No, no. So Deepesh, let's look at yeah, that's correct. But let's look at through financial markets, okay, investment banking side, okay. Yeah. So you are going to use ISDA guidelines to manage your default risk against your clients, okay. Now, generally, from an investment bank perspective, right? They're gonna essentially look at three different types of collateral, okay, which is cash, of course, because cash is king, mortgage-backed securities, and government securities will be the different types of collateral that is used. Okay. Now, when you go through your PPTs, right, you will see real estate and gold and all of that, and those are not wrong. Okay, but when we're talking about a large financial institution, right? Uh, it's You cannot use real estate property to pledge for doing forward contract and all of that. Okay, so largely it's going to be cash, mortgage-backed securities, and government securities. Okay, so good question, Deepesh. So why not ABS? Can anybody tell me why ABS cannot be used as collateral? And I'm not saying it cannot, but it generally is not. Okay, so why not asset-backed securities? Can anyone tell me? Not okay. Yeah, okay, kind of. Well, it's not necessarily liquid. Okay, to a certain extent. Okay. No. So no, hang on. You Okay, so let's understand what is asset-backed securities, right? Because when you talk about asset-backed securities, that name is misleading. It's not actually backed up by an asset, okay? Because when you talk about asset-backed securities, what is the underlying loan? It's education loans, credit card payments, vehicle loans, etc. Okay, so the name is misleading, okay, because it says asset, but the underlying loan on an ABS is a yeah, you can look at it as an unsecured loan. So can you use an unsecured loan as a collateral? Does it logically make sense? Exactly, right? So now when you look at mortgage-backed securities, why is that used as a collateral? What do you guys think? Exactly, right? It's secured, and good Vibur is specific here is that it's backed by a property, right? So there is some it's like an indirect way of having land. Okay, so these are the different types of collateral that is generally used by in an investment banking world. Okay, now there are still other types. Okay, but largely these are your three common types. Okay, and even in this, right, government securities or government bonds. Okay, they have the priority along with cash and then MBS. Okay. But are you guys understanding what I'm saying is that why is collateral management trade in the OTC market is because if you and I enter into a transaction, will the stock exchange care about the default risk between us? Exactly. So that's why we have to do it in the OTC market. Okay. Now let's go back to the question that I asked you, and all of you said that there is more risk of default in the OTC market. Now, that's fine, okay, but can somebody else think a little bit beyond that? Okay, why can't we have a default risk against the exchange market or the order driven market? What do you guys think? Okay, clearinghouse. But Vibor, let me ask you this question. When you talk about a clearinghouse, who is it that so clearinghouse is protecting us from who? Okay, correct. Maintains mark to market. There's no clearinghouse. Okay. Okay, default. Okay, all correct. But you guys, think a little bit more broadly. Let's try and build your connections. Connecting the dots type of scenario. Now, if I enter, now let's say that I'm a client, you're the broker, and you're saying that there is no default risk. Now, the default risk is against who?
So the third party from, yeah, the counterparty. For
Exactly.
example, I have bought a share.
Sorry, Vibhu, can you say that again? You're breaking up, man.
So the counterparty, for example, I'm buying a share, so other party is selling.
Mm-hmm.
So if the selling party is losing money, so he'll try to default.
Exactly. So when we talk about settlement guaranteed and no default risk, it is a default risk against your counterparty, the person that you're selling the shares to or buying the shares from. But is there no default risk between you and I? If I'm the client and you're the broker, isn't there a default risk between us as well? What do you guys think? Okay, good. So, yeah, so Shreya, let me correct you. So, yes, there is a default risk between client and broker as well, right? Now, because see, in some markets, right, the clearing, so there's something known as a broker deal, okay? Now, what happens is that the broker ends up settling the deal on behalf of the client, or and there's no clearing house involved, okay? At that time, it becomes incredibly risky for the broker if the client is not in a position to pay for the shares, okay, or if they sold the shares and the client has not paid them, okay. So now to answer that, so if we come back to that question, uh, where is collateral used, what would you now say? Now, do you guys understand how we arrived at that? Is that yes, there's no default risk against the counterparty, but there is a default risk between client and broker. So the answer to the question is you will use collateral in both the markets, both OTC as well as exchange. Is this clear with everyone? Yeah, making sense? Okay, so take a minute, write this down, and write in your own words why collateral is used in both quote driven and order driven markets. Okay. Uh, yeah, so repo can be considered as giving collateral. Like when you do repurchase agreement, you give collateral. Yeah. Okay. So write in your own words and let me know when you're done, and then we'll move on. Yes, Shreya. So the risk of default is between the client and broker. Okay, everybody done writing? Okay. Now let's understand a couple other things that are important with collateral management, right? Um, Now, let's say pre 2008, okay, before 2008 financial crisis, you are the broker and I'm the client, okay? Deepesh, hang on, good question. I'll come to that. Okay, so let's say that you guys are the broker and I am the client. So before 2008, how collateral management used to work was that the client, okay, would have to give the collateral to the broker. Now, why? Because clients can come and go. Okay, that is one. And clients can default. Clients cannot necessarily do proper risk management, or it's a brand new company, etc. But when I tell you guys that you're the broker, right? Imagine that you're a Lehman Brothers or a Bear Stearns. Okay. Now, do you guys know how old Lehman Brothers and Bear Stearns is as a company? Any idea? Yes. Okay. So yeah, so believe it or not, Lehman Brothers, right? It was founded in 1850. Yeah, it was founded in 1850. Now, if it's a 170-year-old company, do you think uh, a 170-year-old company would necessarily default before 2008? No, not after 2008, but before 2008. Would do you ever think that, oh, you know what, it's a 170-year-old company, I think it's going to default? Would that ever even come to your mind? Yeah, exactly, right. So you wouldn't think, yeah, you wouldn't think that Lehman would default, right? So that's why before the 2008 financial crisis, clients would end up paying the collateral to the broker or the investment bank in this case to protect them, so that the investment bank is protected against the possibility of default. Okay, but now when so one of the reasons why Lehman fell, right? Their risk management, right, was all over the place. The risk management overall, from a trading perspective, right, was not really in line, and everybody was breaching their limits. And everybody was making a lot of money. And let me tell you guys this, right? So if you were, let's say, working in New York or London, um, like in 2004, 2005, 2006, okay, and you just dipped your tiny little toe into mortgage backed securities, right, and traded that just for 3 years, you would have been a millionaire. Straight out, flat out, you would have been a millionaire, and you could have actually made so much money you could have retired. Yeah. So prior to leading up to the 2008 financial crisis, right? If you were in the mortgage-backed securities world, right, and especially in those few years, right, 2003, I mean, five onwards is when it really shot up, right? So 2004, 2005, six, and all of that, even if you just did it passively, right, you would have made millions of dollars. Okay. Now, what happened was that, like I mentioned, right, Lehman, Bear Stearns, and all that, right, the risk management policies, procedures were not very strong, and the CEO was extremely aggressive in, let's make more money, which is fine, right? But the risk was not in place, and when everything started, when the home owners started defaulting, right? One of the major players, I mean, Lehman Brothers basically held that bomb, and it had basically exploded in their face. Okay, and here's the interesting thing, right? So I joined Goldman in 2005, and from day one, okay, on my day of induction, the first word that I heard, that kind of is in put into my skull, and for the 7 years that I was there, right, was risk. That's the only word that you will hear about in a Goldman. Okay, risk, 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 risk. From slightly senior analysts to associates to team leaders to managers to VPs to MDs, right? We used to only talk in terms of risk. Okay, so we were such a risk driven company, right? That we could like we would always think, okay, what could go wrong? What, if this goes wrong, what can we do, etc. But when I joined a SocGen, right, this word risk, like they were literally like they looked at me as if I'm some weirdo thinking that why am I talking about risk? Okay, because the risk culture in Goldman, right, was very very strong, and that's actually one of the reasons Goldman survived the 2008 financial crisis. Now, an interesting thing is that there were actually a couple of people within Goldman Sachs trading desk, okay, um, who knew that the financial crisis is going to start, okay, and we're talking about like end of 2006, early 2007. They realized that the financial markets are going to crash badly. So you know what they did? They didn't tell anyone. Okay, they didn't tell anyone. Rather, what they did was that they sold as much of the mortgage-backed securities as they could to everybody in the market, and Lehman Brothers happily, ate it. Okay, now sort of yes. So that was the other part where they made a lot of money. Was that so they had the ticking time bomb? They realized it's going to explode, so they gave it to everybody. Everybody happily took it. Okay, and on the opposite side of it, they shorted the housing market, plus took an insurance saying that the bomb that is going to explode, I want to take insurance on it, and AIG happily took it. Okay, I mean, gave them the insurance, the CDS contracts. So for Goldman, right, even though especially the 2007, entire 2007, and almost most of 2008, right, they were extremely profitable because they got their bets right. Yeah, and they walked away with billions and billions of dollars. It's not even funny. It's not even funny. They walked away with billions of dollars. Okay, so now what happened was that so now the entire market collapses. Billions are lost. Do you guys know how much was actually lost in the 2008 financial crisis? So in terms of the capital that was wiped out, right? Somewhere on the range of $450 billion. $450 billion was lost in the 2008 financial crisis. Okay. Now, now the regulators came up and said, okay, you know what? This is nuts. This is crazy. We can't do stuff like this anymore. And the investment banks are like, see, we came to you. You guys didn't understand it. It's not our problem. Okay, so all of this was a lot of back and forth. Now at the end of the day, right, the government will not take responsibility. Okay, and we've been seeing that, right? Sure, Vibhor, give me a few minutes. I'll get to Michael Burry. Yeah, so we all know that the government will not take responsibility, right? So the US government basically washed their hands of the thing, saying that it's the investment bank's fault. Investment banks accepted it, no other choice. Okay, so then what ended up happening was that this idea of collateral, so now I'm coming to the collateral piece, right, is that the collateral piece, what so after 2008 they're like, okay, how do we reduce default risk? Okay, so now the collateral piece, the first thought was, okay, you know what, so you guys are broker, I'm client, so I give you collateral, you give me collateral, right? Now, would that make sense that if you and I enter into a contract, I give you collateral and you also give me collateral? Exactly, right? No, actually, they didn't save Lehman Brothers. They allowed it to default. And you know why they allowed it to default? Because at that time, the Treasury Secretary, the governor of the Central Bank of the US, he was the ex-CEO of Goldman. And Goldman and Lehman, right? A little bit of bad blood. Yeah. So they allowed it to they allowed it to go into bankruptcy. Okay. So, uh, so it doesn't make sense that I give you collateral, you give me collateral. Now, what if both of us default, one of us default? It doesn't make sense. So, and we talked about this yesterday, right? So now, what the regulators ended up doing was they created the CCPs, okay, central clearing parties, which acts as a clearing house for OTC transactions. Now, the idea behind this is what? Reducing default risk, okay? Now, what will happen is that both broker and client would deposit the collateral with the CCP. Okay. Now the collateral again will be cash and government securities along with a haircut. Okay. But isn't this a lot better way to efficiently manage default risk? Creating a CCP, everybody dumps their collateral there, and it's the job of the CCP to manage that collateral. Isn't it like it works out awesomely? I feel. Yeah. Okay. I don't know if you guys. I mean, I like that concept. It's quite cool what they came up with. Yeah. Yeah. Okay. So, sorry, regulators must be thinking if this had been in place for, yeah, potentially 450 billion could have been saved. A lot of people wouldn't have lost their jobs. Suicide rates. So one of the things that you guys might not know about is during the 2008 financial crisis, right, in the U.S. and across major financial centers, including India, right, Mumbai, suicide rates shot up because everybody was on the wrong side of the market. Market collapsed. They didn't have the ability to pay that much kind of money, so they ended up losing, yeah, billions of millions of dollars, crores of rupees, and they didn't have the ability to pay that back. So a lot of them actually ended up committing suicide. So that's the dark side of it. Yeah, yeah. So when we talk, so there's a guy called Michael Burry, okay, who is running a hedge fund. Okay, now there are a few people, about 20, 21 odd people in the entire world, right? They knew that the financial crisis was coming. They could make out that the home brokers sold a lot of the loans in the market. Okay. And they sold it to people who couldn't afford it, and a lot of these things, right? And the mortgage-backed security, what do you call it, machine, right? Just kept on churning and churning and churning. So when what happened was that when so Michael Burry, what he started looking at was, if I'm not mistaken, right, he was looking at the yield curves of bonds and how it was going out of skew. I could be wrong, but I remember so there's a book called The Big Short. So I read that a long time ago, and there's also a movie on it. So that is essentially when he started looking at the yield curves, right? He ended up realizing that, you know what, the market is coming in for a big collapse, and specifically the mortgage-backed security would drag down the entire financial markets. So he went out to AIG, Goldman, actually not even AIG, he went out to Goldman and a few other investment banks and bought CDS contracts from them. Now, if you guys have seen that movie, right, he had actually entered into Goldman, and he told him that I want to buy CDS contracts. And Goldman was thinking, "Hey, why the hell does this guy want to buy CDS? Everything is perfect, right? Everything is fine." But they didn't realize that. Okay, so they happily sold him millions of dollars worth of CDS, and he bought it. Okay, now the other thing was that it's difficult to predict exactly when the volcano will erupt. Okay, you know it's going to happen, but you don't know the exact date and time, right? So what happened is that he bought millions of dollars of CDS contracts, and as a hedge fund, he has to disclose all of this to his clients, right? Because it's private, and they've all put in a lot of money, and they were getting upset with him, angry with him, saying that why are you putting dumping so much money in CDS? Go and buy more of the mortgage-backed securities. That makes more sense to us. All of that, but he just told them, trust me, hold on, it's going to happen, it's going to happen. And when it hit, right, Goldman went back out to him and rebought the mortgage-backed securities at, at a much higher value, and he ended up making a couple $1 billion in the process. Yeah. Yeah, yeah. Right now, right? So we also have a mini financial crisis because of COVID. Okay, but because it's an election year, right? It's so all the politicians are doing everything they can to make sure that the markets stay up. Yeah. Okay. So take a minute, write this down, and then we will move on to the next part. Yeah, true. So even Indian markets that we know, Vibur, I feel is kind of overbought. There is no reason why markets are supposed to be at 10,800. I feel. So in OTC market, seller can act as a broker. Yeah, yeah. So in OTC market, right? So the investment bank can act as a counterparty to the trade, or it can act as a broker to the trade. Okay, everybody done? So, one thing that you guys need to be aware of, right? The global markets, right? It's still very, very fragile. I'm not talking not from 2008, but because of COVID, right? The markets are very, very fragile. Okay, so we'll have to see what happens. Okay, but you know, be what do you call it? If you invest regularly, be careful. If you uh, you know, well, you guys are freshers, so you're okay in terms of job security. Okay, but one thing I will tell you guys, it's not to scare you. Okay, but working in the financial markets, right? There is a job risk. Okay, see, when the markets are up, you will have jobs. When the market is down, guess what happens to your job, right? So that is the only risk. In working in the financial markets. Now, if you work in a retail bank and all of that, commercial bank, that's okay, right? You're not really at a risk to the market. But when you work in the capital market side, right? So, investment bank, custodian, what else is there? Maybe even a depository, a broker, all of that, right? So when the markets crash, right, there is a possibility that you might lose your job. Yeah. Okay. Now, let me ask you guys a question. Let's say that you and I enter into a forward contract. What does broker and client would deposit? Yeah, so that's what I've been saying, Shreya, is that post 2008 financial crisis, the regulators have said that both parties have to deposit a collateral with the CCP. That way, you can minimize your default risk. Okay. Now, let me ask you guys a question. Now, let's say that you and I enter into a forward contract, okay, today, and let's say we take a 10 months or 12 months. So, generally, it's a maximum of 12 months, right? So, let's say we take a 10 months delivery, okay, of the underlying asset. So, I'm a buy forward, you're the sell forward, okay. Now, when do you think we should give the collateral? When do you think we should pay the collateral? Okay. Okay, on trade date. Okay. Okay. All right. Now, okay, now let's break this down, okay? And I want you guys start thinking about these kind of things, right? Is that if you and I enter into a forward contract today, are we exchanging anything? We've just entered into an agreement, right? Have we paid each other some sort of premium or a margin? Have we done anything like that? Okay, correct. So we've not done anything. We just said, you know what? We shook hands on a contract saying that, okay, Rakshit, I'm going to sell you 50,000 shares of Apple at 350 10 months from now. Okay, I agree. Okay. Now, because we've entered in the contract, now there is a risk of default. Okay. But that risk of default is not on the day you enter into the contract. Okay. Rather, now what Deepesh is saying is on settlement date, that becomes too late. Okay, on settlement date, the collateral being paid, right? That becomes too late. Now, why does it become too late? Because if you are going to give the collateral on settlement date, right? What if on settlement date the collateral doesn't move and you default on your payment? So the collateral is not given, and also the payment on the transaction is not given. So ideally, what are you going to do is that you are going to pay the collateral in SD minus 2, meaning settlement date minus 2. So if we take a 10-month forward contract, right? So that can come up to be like March or April next year, and today is the 12th. So let's say March 10th is when you and we will deposit the collateral with the CCP. Okay, so we will not do it on settlement date, because on settlement date that is the greatest risk of default. So to minimize that, we're going to do that 2 days before the settlement date. Is this clear with everyone? Yeah. So collateral will be paid on settlement date minus 2. Okay. Now, when we talk about like what we mentioned before, right? It's, yeah, fixing rate will be SD minus 2. Yeah. Yeah. So now you understood the logic why you do it as D minus 2, so that you can, so on an NDF you'll be able to arrange for that cash and make good on your delivery. Yeah. Yeah, see, that way, the financial markets, right, is really awesome. And is, and I'll tell you guys one thing: you work long and hard, right, in finance, right, you seriously will meet some of the smartest people on the planet. And believe it or not, right, so I believe in that you can always improve your intelligence. Okay, so the intelligence that you're born with, okay, is not the intelligence that is with you your entire life. Okay, so what happens is that as you keep pushing your brain into more complexity, right, you will actually become smarter, right? And the more complex stuff that you put your brain through, the more intelligence you'll actually get. Okay, you'll actually increase your IQ, and I can definitely testify to that because I was dumb as hell. I was very very dumb in school and college. Like in college, right? I basically sat in the back bench and slept through entire 3 years of college. I literally had no idea. Okay, and I had one notebook for all subjects for each year. Okay, so that's how good a student I was. But I'm pretty sure all of you guys are a much much better student than I am. Yeah? So, and that's how why it's a little funny that I ended up in finance, because most of my classmates, right, even though they did specialization in finance and all that, right, they never even made it into finance. They all got marketing jobs and this job and that job. So when uh, we had like a catch up, right? Like after 5 6 years, all these guys were doing something random, and I was the only one in finance. Uh, so that's why I always find it funny, because you don't know where your career, where you're going to wind up in, right? Okay. So now coming back to this, now because we're talking about collateral management, right? It is governed through ISDA. Okay. Now one of the parts of ISDA is what we call as the CSA, which stands for Credit Support Annexure. Okay. Now the credit support annexure is a negotiable document where you can negotiate the type of collateral that you will keep with the CCP, and also how many days before the settlement date you will pay the collateral. Okay, so in ISDA, if you guys remember, right, I showed you the ISDA documentation, how a trade confirm looks like. Now, an attachment to the ISDA confirmation is what we call as the CSA, the credit support annexure. Okay, now in the credit support annexure, this is a document that you can negotiate with your client and counterparty, saying that, okay, you know what, I am going to keep grade A bonds, or I'm going to keep grade B bonds, whatever it is. Okay, you can negotiate the type of collateral that you want to keep with each other. And you can also negotiate, do you want to do it, so generally you will not do it on settlement date, so you can even do SD minus 1, SD minus 2, but generally it's SD minus to be 2 to be on the safer side. Okay, so and what kind of collateral, what will be the haircut, will it be a 20% haircut or will it be a 5% or a 10%? So you can negotiate all of this, and that negotiation you can do in the CSA, the credit support annexure. Okay, is this clear with everyone? Okay, take a minute, write this down. I think largely in this batch we have people who've done pretty well in college, right? A lot of you guys have scored really well. I saw some of your resumes. You guys should be very happy with that. But again, education is not necessarily a guarantor for success in life. So that's also there. 1 second. Dipesh, it's fine. You are a fresher, right? So it's fine. You can go for the experience. Okay, let me know when you're done. Okay. So, okay. So understood when will collateral be paid and CSA, etc. Right? Okay. Now uh, let me tell you guys about the next thing, which is a. It sounds complicated, but it's a pretty straightforward concept. Okay. Now let's say that you and I enter into some sort of contract. Okay, and I give you $100 million in corporate bonds, okay, or government bond, whatever it is, okay. Now let's say that uh, I've given you the corporate bond 5 days before the settlement date of our contract, okay. Now during those 5 days, let's say a corporate action event takes place. Now because it's a bond, let's say that they make that coupon payment. Now my first question to you guys is, who will receive the coupon payment? Will I receive the coupon payment or will you receive the coupon payment? Uh, Let me say it. Okay, let me restart. Right. So let's say that you and I are in a forward contract. Okay. So you are the client now. Okay. Okay. Anything. So I'm the client now, and you're the broker. Now, if so I'm going to give you $100 million. Okay. So if I'll give you $100 million in corporate bonds, okay, corporate bonds, and let's say during those in that 4 or 5 days, right, the what do you call it? The coupon payment gets paid. Yeah, the coupon payment is paid. Now the coupon payment, who will it go to? Will the coupon payment come to me, who's the owner of the bond, or will it go to you because you're the holder of the bond? Okay, so you guys are saying that I will get the coupon payments. Okay, all right. Okay. You guys. Okay. Let me clarify this. Okay. Now, yeah. So what Sora is saying is correct. Is that, see, from a company perspective, right? A company will not keep track of, hey, this bonds that you hold, is it, did you buy that bond outright, or are you, is that a collateral that's been given to you, etc. They're not going to check all that. So the coupon payment is given to whoever is holding on to the bond on the coupon date, okay. And it could be coupon date, or it could be even maturity of the bond, whatever it is, right? So whoever is holding on to it will get that. Now legally, is this now, so now that you know that the coupon payment will come to you, is that coupon payment legally yours? What do you guys think? Is that coupon payment yours legally? That's two. What about the others? Come on guys, it's not difficult. So correct, it is legally not yours. Why? Because see, when you talk about a collateral that's given, right? Now that collateral is a temporary movement. Okay, the collateral is temporary movement. So once the deal is done, right, on settlement date, the collateral will come back. So when the coupon is paid, right, the bond holder will get the payment. Okay, whoever is holding the bond. So it could be, for example, it's you, but it's not yours. Okay, so what happens is that you you will have to pass on the coupon payments back to me. Okay, you will have to pass on the coupon payments back to me. Okay, and that is known as manufactured dividend. Okay, sounds fancy, but it's not, but we call it as a manufactured dividend. Okay. Shreya, I'm sorry, I didn't understand what you're trying to say here. Exactly, it won't be legally yours. Yeah. So that's why you have to transfer it back to me, and that's why it's known as a manufactured dividend. Okay. That way in equities we have homemade dividend. Ha, okay. Okay, because if there's no default and you get bonds. Yeah, exactly. Okay. All right, I'll explain again. Okay, so I'm the client, you're the broker. Okay, so I give you $100 million in corporate bonds. Okay, and during that time, coupon payment is made. Now, see, I'm just giving it across as you and I, but now let's say that even if we deposit that coupon payment, I'm sorry, the collateral with a CCP, the logic is the same. So what happens is that the company will pay the coupon payment to whoever is holding on to the bonds as of that date. Okay, as of that date, whoever is holding on to the bonds, right? They are going to pay them. Okay. Now what will happen is that though that coupon payment legally is not yours because it's a collateral. Okay, and when we settle our transaction, you will have to give me the money back, right? You'll have to give me the the collateral back. So that is why that coupon payment that you received, you will have to transfer it back to me, and that's known as manufactured dividend.
Uh, you're saying that you purchased bonds from a company and then issued it to a broker,
Mm-hmm.
and at the meantime, the company pays the coupon. So then it is not legally yours. You have to pay it to the broker.
Yeah, I mean, whoever is the original holder of the bond. Now, if I'm the broker, and let's say Vibor, let's say you're the client and I'm
So,
the
so
broker,
what
right?
is the collateral here?
Sorry, sorry.
What is the collateral here? I don't understand.
No, so the collateral is the corporate bonds.
Okay.
So we would, let's say that you are the client and I'm the broker, and you deposit, let's say, $100 million in a government bond or corporate bond, whatever it is. Okay. Now I'm holding on to it as collateral to protect myself against a default risk against you, right? Now, in case so during that time, if a coupon payment is made, that payment will come directly to me and not to you. Now, legally, it is not mine, this coupon, these bonds, because I've not bought it from you. You've only transferred it to me. Okay. Now, what I have to do is that after the settlement of our transaction on our contract that we have, right? I have to give you your collateral back. Okay. And now at that time, when I give you your collateral back, I have to also give the coupons that I received on the back of the collateral. Okay. And this is known as manufactured dividend. Is it clear now?
So, what is the advantage of transferring it to the broker if
No,
we eventually have to take it back?
no, no. So there's no advantage, right? So see, we're talking about collateral management here, right? So you are depositing collateral with me, or let's say even if we take it as a CCP, right? Now let's say you are client A and Shreyas, the broker, and I'm the CCP, right? So you both will deposit your collateral with me so that you minimize default risk against each other. Now during that time, the collateral is held with me, a coupon payment is declared, okay, or a coupon payment happens, the company will pay the coupon directly to me, but it is not mine. So I have to transfer that back to you, and that is known as a manufactured dividend.
Okay.
So temporary holder will receive the coupon payment, and at settlement, total coupon payment manufacturer has to be uh, paid to the permanent holder. Yeah, something. Yeah, correct. That's fine. As long as you guys are understanding. Vibor, did you understand? You seem doubtful.
Wait, I'm not just understanding that if we are purchasing a bond, then why are we depositing it with the CCP?
Because
We can
see,
directly receive the coupon.
sorry, you can directly.
We can directly receive the coupon from the company when it's paying.
No, no. See, so
Why
when
will we deposit?
yeah, no. See, what I'm trying to get at is, see, let's say you are the client and Shrey is the broker. I am the CCP, right? Now both of you have to give a collateral to me because now let's say both of you enter into a forward contract and settlement date -2, you both transfer collateral to me. Okay. Now let's say the collateral is government bonds, and on that day, let's say a coupon payment happens. So what I'm saying is that the government, right, or whoever is managing the payment of the coupons, they are not going to check with every party of, hey, does this legally belong to you, or is it a collateral, or is it something else, etc. They're not going to do all of that. So they are just going to pay the collateral to the person. I mean, they're going to pay the coupon payment to whoever is holding on to the bonds at that time. So if I'm holding on to your bonds at that time, Vibhor, they will pay me directly. But since it is not mine, these bonds are not mine, and I'm holding it as a collateral, I need to give this back to you, and that's known as manufactured dividend.
Okay, now got it. Thank you.
That's clear. Okay, cool. Okay. So the ownership of the bond acts as a collateral, not the coupon of the bond. Correct. Yeah, that's good. Yeah, that makes sense. All right, are we clear with this? Everybody done writing? Can we move on? Okay, so that's it in terms of what do you call it? In terms of collateral management. Okay, so now we'll move on to what do you call it? Securities lending and borrowing. Okay. All right. So now, as largely what we have discussed, right, is most of us think that borrowing and lending largely happens with money, right? Cash. Okay. But that's not necessarily true. You can also do securities. You can borrow and lend securities in the market as well, and you can make some sort of spread or profit of that. Okay. Now, when we talk about securities lending and borrowing, right? Now, what is it essentially is that securities lending is a temporary transfer of securities by a lender to a borrower with the agreement by the borrower to return equivalent securities to the lender at a pre-agreed time. Okay, sounds very, very much like a repo. Okay, but it's not a repo. Okay, uh, but it has some of the features of that, right? So when you talk about SLB, right, it's the temporary transfer of securities. Okay, it is not a complete transfer. Okay, now again, if you look at securities lending and borrowing, right, it is done in the OTC market, and because and I'm talking about internationally. Okay, now in India also we have SLB and all of that, but it's a very complicated process with a like a T+10 settlement and all of that. Okay, so SLB essentially, right? Again, is traded in the OTC market and therefore is managed, or I wouldn't say regulated, but follows the ISDA guidelines. Okay, so stock lending is the temporary transfer of securities by a lender to a borrower with the agreement by the borrower to return equivalent securities to the lender at a pre-agreed time. So it sounds very much like a repo, but it's not. Okay, so take a minute, write this down, and then we'll move on to the next other aspects of it. So Deepesh, the reason why, right? Because it's trades in the OTC market. You cannot do securities lending and borrowing, right? Through the exchange. So anything outside the exchange will generally be managed by ISDA. Yeah, more or less. So see, in India and all of that, we don't have a very big OTC market, right? And it's heavily regulated by SEBI and RBI. So when I'm talking about ISDA, right, I'm largely talking about US markets, UK and Europe, Hong Kong, Japan, and also a bit of China as well. Yeah. But the rest of the world, right, not much. Good question, Shreya. We'll come to that. First, let's talk about why SLB happens, and then we'll talk about what is the benefit to the lender and borrower. Okay, everybody done? Okay. All right. So now let's look at why securities lending and borrowing takes place. Okay. Okay. So when you talk about why securities lending and borrowing happens, right? First and foremost, it's that it ensures the settlement of trades can take place. Okay, to ensure settlement of trades take place. Now, what does this mean? Okay, is that now let's say okay, so I'll type this example out. Let's say on settlement date, uh, I have to deliver 50,000 shares of Apple to you. Okay, so let's say about 90, right? So I have to deliver 50,000 shares of Apple. Now, when I look at my custody account, and I have only, let's say, 30,000 shares. Okay, So therefore what? I'm short 20,000. Okay. We'll come to that before. Not exactly used in shorting. We'll come to that. So here, what I'm trying to get at is that I have to deliver 50,000 shares. So you have bought 50,000 shares of Apple, and when I look at my custodian account, I only see 30,000 shares, and I'm short 20,000. Now, because you see, generally, right, with clients, you cannot do what we call as partial settlements. That means that you have to settle the full quantity, not a partial quantity. Now, if I'm short 20,000 shares of Apple, and I don't see any other deal settling, okay, for Apple, what will I do? I need to. So this is the settlements team that does this, by the way. I need to go to the front office team and ask them to borrow Apple shares for, let's say, 4 or 5 days or whatever it is. I want to borrow Apple shares. I'll just keep it simple for now. Okay. So what happens is, now why it trades on OTC is that in OTC you can immediately transfer the shares to me. Okay. And I in turn can transfer the shares to you for a total of 50,000 shares. Okay, so this is what we mean by to ensure settlement of trades can take place. Okay, so I'm supposed to deliver 50,000 shares, but I only have 30. So, and I don't see any other deals settling for Apple shares. So what does that mean is that I need to go out to my front office and ask them to borrow 20,000, 20,000 shares. Okay. Are you and CIBOP in a forward contract? No, no. So you guys, so you and I are in a normal equity deal. Okay, you and I are in a normal equity deal, and I have to deliver 50,000 shares to you. Yeah. Is this idea? I mean, do you guys understand it, right? Basically, it's an equity deal. 50,000 shares. Okay. Now, so okay, Akshay, I understood your question now. Is that uh see in foreign markets, right, you have what we call as broker settlement. So broker will take the obligation to settle the transaction and not necessarily the clearing house. Okay, so if it's a broker settlement, I have to arrange for those shares. Okay, I have to arrange for those shares and deliver it to you on settlement date. Now, on settlement date, I noticed that I have only 30,000 and I'm missing 20, and I don't see any other deals where 20,000 shares of Apple are coming into my custody account. So that's why I go out to my front office, tell them that, hey, you know what? I might fail against CIBOP 90. So can you guys do a borrowing? Can you cover that 20,000 shares? Okay, we call that as covering. So what the front office guy will do, right? He will go out to other brokers and other clients to find out whether they have 20,000 shares of Apple or not, and if they're willing to do a securities lending deal. So we will borrow. Okay, we'll borrow those shares. Again, that share transfer will happen in the OTC market. It'll hit my custodian account almost immediately, and then I can deliver the 50,000 shares of Apple to you one shot. So that's what we may mean by to ensure settlement of trade can take place. No, no. So we'll come to so here we're only talking about shares. We're not talking about cash. Okay. So it's I'm only transferring shares to you. Okay, is this clear? Guys, the idea is very simple, right? Is now let's say that you're running a business. Okay, your client ordered, let's say, 100 pieces of a what do you call it? Let's say a wallet. Your client ordered 100 pieces of wallet, right? and you notice that in your inventory you only have 70. So what will you do? Now your client obviously wants 30, so you're not going to shortchange your client, right? You're not going to say, you know what, take 70 now and I'll give you 30 later. No, what are you going to do? You're going to find some other guy who has where you can borrow the 30 um, wallets from him and deliver that to your client. Okay, that's the logic here. Is this clear with everyone? Okay, the next point, okay, is to overcome the flaws of short selling. Okay, now what do we mean by this? And we were it kind of, it does help you to manage short selling. Now let's understand one thing. What is short selling? Now there are two types of short selling. Okay, and I think some of you might be aware of it, but some of you are not. Okay, so there are two types of short selling. One type of short selling is you borrow shares from your broker and you sell it in the market. Okay, and your hope is that you buy back the shares at a lower price. So you sell it at 100, buy it back at 90. That 10 rupees is your profit. Then you give the shares back to the broker. That is one aspect of short selling. Now, the other aspect of short selling is what we call as a naked short sell. Okay. In a naked short sell, you don't own the shares. You're not borrowing from the broker. You are just selling those 100 shares in the market, expecting the share price to go down. Okay. And once the share price goes down, you buy it back at a lower price. And what happens is that the net obligation towards the exchange is zero, or to the clearinghouse is zero. So that is why you can do this. Now, in a lot of the markets, right, foreign investors, there's a regulation that foreign investors are not allowed to short sell. Now, the reason why foreign investors are not allowed to short sell is because since they have a lot of money, right, they can really dump shares of a company, like millions of shares, and they can actually bring the stock price to such a low point. Okay, so so to over so largely, uh, short selling for foreign institutional investors is uh, is not possible in certain markets, especially in emerging markets like in India and all. FIIs cannot do short selling, but retail investors can. Now, let's say that by mistake, right, on settlement date, you realize that in your custody account, you don't have, let's say, 50,000 shares of 50,000 shares of Apple, let's say, or whichever company you want to take. Yeah, you don't have those shares, and now because you cannot short sell in the market, because then you'll have a lot of fines that you'll have to pay, and there could be regulatory implications, right? So what you can do is that you can again execute a securities lending and borrowing deal where you can borrow the securities from somebody, okay, a market participant, delivered to the depository so that your obligation to the clearinghouse is met, and later on you can buy it back at a you can buy those shares back and you can give it to your lender. Okay, so that's the second point, to overcome the flaws of short selling. Does that make sense? So you have an equity deal on the exchange, but you messed up. You don't have the shares in your custodian account. So, and since you're not allowed to short sell in the market, what are you going to do? You're going to borrow the shares in the market, and you are going to do what? You're going to transfer to the custodian. Custodian will give it to the depository. Okay, so that way you avoid a short sell fine. Okay, is this clear with everyone? Does it make sense? That's the easiest way to understand it. Okay, and final point is that you can do making activities and other trading activities such as hedging and short selling. You can do that as well. Okay. So from a retail investor perspective, I think you can, Annette. So Annette's question is, can we use it as leverage? So I think from a retail investor perspective, I think you can do it. Okay. But from an institutional investing perspective, I don't think you can do it. No, so Deepesh, it's for both. Yeah. So this avoid the to overcome flaws of short selling, right? It's for both markets, both for exchange and OTC. Okay. Take a minute, write this down, and then we'll move on.
Sir, am I audible?
Yeah, yeah. Go ahead.
So please recap to overcome the flaws of short selling, please.
Why, man? I just did. Okay,
Sir.
it's simple. I just did it right now, right? Listen carefully. It's see, I'm not using complicated language. Just understand what I'm saying is that when we talk about short selling in a lot of the markets, institutional investors are not allowed to short sell. Okay, so in case by mistake it happens, to cover or to avoid the short selling, you're going to borrow the securities in the market and meet your obligation to the clearinghouse. That's it. That's what I mean by that.
Okay, sir. And it is for both over the counter and on exchange trade also.
Yes, yes, exactly. Because you can like when I say mistake, right? Basically, you didn't check your inventory and you sold shares that you didn't have.
Okay, sir.
Everyone done writing? Okay. Now let's answer the question, what does the lender, okay? So we'll talk more from a lender's perspective, and what does the lender get by doing a SLB deal, okay? Now, first and foremost, whenever you're bought lending, right, anything, whether it's cash or securities, you're going to charge them for it, okay? So there is a way, so basically the lender gets a fee for facilitating the lending transaction, okay? And it's also a way for the lender to derive an additional income on securities that they hold, okay? Now, for example, right, if we talk about cash, when cash sits in your bank account, it earns credit interest, right? Now, if you have security sitting in your demat account, does it earn anything? Exactly, right? There is no earning of anything. You don't earn interest on securities, okay? So now I'll give you guys an example, okay? Now let's say that um, I want to lend 50,000 shares of Reliance at, I think I saw it at 1,800, right? It hit something like that. 1,878. So let's say rupees 1880. Okay. So I'm going to lend 50,000 shares of Reliance at 1,880 for 5 days. Okay. And I'm going to charge, let's say, 15 basis points as commission. Okay, so how do we figure this out, right? So 50,000 into 1880, that's a huge amount. Anybody have an idea? Hang on, I'm doing it on my calculator here. Into 1880. Okay, so some crazy amount, which is 9 crores, I think 9 crores 40. 1, 2, 3. Okay, or 94 million. Yeah, 3. Hang on, 3. Okay, so 94 million rupees is the gross value. Okay, now into 15 basis points. Okay, into 5 by 360. So how much would we get? And get rupees 1,95,833. Exactly. Yeah. So as a lender, I earn this 1.95 lakhs, okay, for 5 days, and that's pretty good, right? 1.95 lakhs for 5 days, yeah, on a 34 million, $94 million notional or rupees, right? And what has happened now is that, see, now, like I mentioned before, right, it is a temporary transfer. So what happens is that I transfer the shares to you, and you transfer the shares back to me. But then that fee of 1.95 lakhs is what you have to pay. Now, what I've done is uh, I have received an additional income on the securities that I own. Okay, so that is what the lender gets by doing a securities lending deal. Now, what does the borrower get? Basically, they get to avoid fines, they get to avoid penalties in the market, and or any sort of action taken by the regulator. So that is what the borrower will get. They avoid fines and penalties, and the lender will earn a fee for doing that borrowing for those X amount of days. Not one, sorry, own. Okay. Okay, is this clear with everyone? So that is what the lender gets. Okay, take a minute and write this down. It's clear with how I arrived at that number of 1.95. Yeah. So all you're doing is 50,000 into 1880, you get 94 million into 15 basis points. Okay. So 15 basis points on your calculator, you just do 15, hit the percentage sign. So what will happen is it'll become 0.15 into 5 by 360, and you get 1.95. Okay. So let me stop your recording.